Sure.
Hello, and welcome to Palisade Corporation's webcast, Pricing and Managing Liquidity Requirements of the Futures Portfolio for a Gas Distributor, presented by Vladimir and Tokarov. My name is Jameson Romeo Hall, and I will be your host today. And I'll be available to help answer technical questions by chat. At this time, all attendees are in a listen-only mode. Please note that as an attendee, you are part of a larger audience today. The attendee list is suppressed to maintain attendee privacy. We will be holding a Q&A session at the conclusion of today's presentation. You may ask an online question anytime throughout the presentation by clicking on the Q&A panel. I would also encourage you to visit our website and sign up for a free trial download of our software, including our lead products, At Risk, and the Decision Tool Suite. Vlad, the presentation is all yours.
Good morning, everybody. Good day and good evening, and thank you for taking some of your precious time to attend this presentation and listen to what I have to say. As was already said, the topic of the presentation is managing liquidity requirements for gas distributor, but before I move directly to the topic, I just want to make a general observation that in industries like banking and insurance, usually the risk management component of the service that a provider provides to a customer is well understood, and sophisticated providers are good at pricing what they offer and managing the risk that they take on behalf of a customer. Of course, we have to open parentheses here. AIG was a glaring exception of this, but in general that's the case. However, as we start moving away from those two industries, the risk management component of services and products embedded in the contracts between providers and customers are less and less well understood. They're less appreciated sometimes by the customers, and they're not properly priced and properly managed by providers. And my personal belief in the coming years, there's going to be a big improvement in increased sophistication of outlining these risk management components as a service element and their proper management and pricing. In my presentation, I'll set up the context, the situation, describe the problem, and then I'll go to the solution and the benefits of the solution. So let's start without further ado. Price lock service and hedging by a distributor. As we all know, gas distributors sign long-term contracts with a variety of customers. They usually basically commit the supplier to supply certain volumes of gas to a user over a period of time, month by month, at a specific price for each month. These contracts come in generally in two flavors. One is a fixed price, where the provider commits to a fixed price for this future period. Again, fixed price, but different for every month. And the second one is a spot price with an option for the customers to convert to a fixed price at any time before the settlement of the contract and the delivery of the gas. Obviously, each distributor immediately, especially after fixed price, has price risk exposure, and if they're not able to pass this to their wholesale suppliers, which sometimes is the case, they basically have to manage this price exposure either through completely hedging it away, buying futures contracts or some portion of it, or some other hedging strategy. Buying futures, specifically here I'll talk about the futures strategy. So buying futures contracts at exchange immediately requires setting some initial margin call, even though, as we all know, the futures contracts at purchasing have a zero net value. And then as the contract moves through time and approaches maturity, this initial margin call is adjusted by the exchange, and in addition to that, depending whether the contract is in or out of the money, there is additional mark-to-market margin calls. Basically, by offering the customers the option to lock in a future price, a gas provider provides a service, and he's entitled to basically have a reasonable profit to the service. And not only that, but the service triggers additional costs for the provider, the main one of those costs being the potential requirement to lock in capital as margin calls related to the futures contracts. As every service, the challenge for the provider is to properly price it. If the assumptions are too optimistic, this means that the price that the provider charges for that is too low, and the provider absorbs some losses if necessary. And if the assumptions of the provider are too pessimistic, it overprices its service and loses price competitiveness. So again, the challenge is to get it as closely as possible to the right answer if such answer exists. So what are the objectives here is for a provider, and obviously this is ongoing process, so it has to set a well-established process of continuously assessing these liquidity requirements and incorporating them. This obviously requires setting the right methodology, the right analytical tools, the right information flows, and execution process and responsibility. Each assessment has to incorporate the past experience of the provider, the expectations for the future, and the probabilistic nature of this assessment, because they're forecasts. Having those capabilities, in addition to this commercial impact, allows the provider to have a better analysis and better understanding of the pricing risks, to have more transparent and consistent pricing of these pricing risks, if I may kind of say it this way, and also increase ability to analyze different hedging strategies that optimize its profitability depending on the specific conditions. I already talked briefly here, but I'm just showing an example of initial margin call. So the initial margin call is set on the date of execution of the contract. It has to be posted in cash or equivalent collateral, and the amounts differ depending on the maturity of the contract, on the current price level, on the assumed volatility that the commodity mercantile exchange assumes. And this requirement change as the contract goes to maturity. And here's one example of a volume for a 10,000 volume contract. In addition to the initial margin, as I mentioned, there is an ongoing mark-to-market margins for the fixed price. As the contract, and if the contract is out of the money, there is a dollar for dollar requirement for additional margin calls. If we have a portfolio of futures contracts, the in the money netted with the out of the money positions of this portfolio, and of course the total margin can never go below the initial margin that has been set. And here is basically the structure of the application that is attempting to address this challenge. There are two fundamental modules. One is the parameter estimation module, and the other one is the forecast simulation module. The parameter estimation module basically takes historical prices, and we'll talk about this in more detail, analyzes them and extract the right parameters for a simulation process of future prices. And then the simulation parameters are combined with a price trajectory forecast and with the gas distributor's cost and price of liquidity. And then this all goes into the forecast simulation module, and after simulation, this module provides the following fundamental outputs. One is the liquidity profile for a particular contract, so we can see what what we'll have to secure as potential liquidity. The contract liquidity cost and pricing, which is the thing that we already talked about, and then on aggregated level, the overall liquidity requirements of the whole futures portfolio that the provider is likely to face in the future. Here, very briefly, I'm just touching about the price forecast. The gas distributor is observing the futures curve, and then it has to deliver, basically develop and set up settlement price at maturity curve, or some people call it future spot prices. They're usually a little bit below what the futures curve is. Again, some distributors can take a significantly different view, but basically that's the forecasted price that we expect to be the actual price at the month when a given contract is settled. Of course, this assessment is probabilistic, and that's the whole point of using this just as an average level, and we simulate the possible deviations of that in our forecast. Here, I'm going to talk very briefly about few major characteristics of the price forecast that have to be present for this forecast to be a good one. The first one is time to maturity. So basically, as a contract goes, especially longer contracts, in applications, we give the user the chance to simulate even 5-year contracts in the future. I know that most contracts go out only 2 or 3 years, but that's sufficiently far in the future. So we know that as a given contract goes through time and approaches maturity, not only it's the price level changes, but also the range of volatility and the shape of this volatility change over time, and this has to be reflected in our simulation. The second one is, I call it proportionality. It's basically very, very basic, that we all, as we saw in the price curve in the previous slide, for example, January prices are always higher than May prices, so our simulation has to preserve this proportionality as we simulate the whole portfolio in the future. Excuse me. The next characteristic is correlation. As we all know, prices are correlated, so we have to preserve, and when I say correlation, it's not perfect one, so we have to preserve the characteristics of this correlation in our simulation exercise. Seasonality, it's almost a subset of time to maturity, but as we know, contracts at different times period have different character. The volatility has different characteristics, not only their price level, depending on seasonality. Just to kind of explain this more practically, so that it's not just an empty phrase. So if I have a theoretical contract that matures, let's say, in September 2016, as it approaches, there's going to be a time to maturity impact on the character of this price volatility, but also this contract is going to go twice over the seasonality of, winter peak, spring, summer, fall. So there's going to be a seasonality component of difference of the behavior of this contract. So this has to be captured. And the last one, we call it the smell test. So when somebody who has been in the industry, who has looked at thousands of prices, when they look at the simulated price, it has to feel, it has to look like a real price, like a real historic price, so that the exercise is credible and beneficial. Here, very briefly, I'm touching on the modeling. We're using something, again, I don't know what the audience is, but something that's called geometric mean reverting model for the delivery price. It basically models the price at every future period as a weighted average of the price of the previous period and the forecasted price for that month, for that contract. And this weighted average is driven by the mean reverted coefficient. And then in addition, we have the sensitivity of the random shocks, which depend on the price volatility for this contract, for this month, for this maturity. And then we have the random shocks itself. Here I'll go very briefly kind of describing the two modules. So this is the simulation parameter estimation module. So this is basically looking at the historical prices. So the module picks the right strips of historical prices, analyzes them, and extracts the parameters for this mean reverting geometric Brownian motion simulation process. And then provides them to the user. So the user here has the chance, first of all, to look and to see what has been going on. And then, as with every forecasting model, the question is the future going to look like the past? So if we believe that, you know, the seasonality, the overall level of volatility, the range of price changes is going to look the same as in previous periods, we can just take those parameters and use them directly. But obviously there's a rich opportunity here for basically expert judgment and say the future is not going to look like the past. It's going to be, the price volatility is going to be lower, higher. It's going to change here. It's going to change there. So there's all this flexibility to embed this expert intelligence into the model in addition to the mechanical analysis of the past data. The forecasting module basically creates, so we forecast daily prices for every type of contract with every maturity with specific parameters for the specific month of this contract. So you know, theoretically, if we have a portfolio that represents all the maturities, we simulate 50,000 different individual daily prices with the correct parameters, and then based on this price simulations, we identify the daily liquidity requirements, and then from there this can be aggregated, and with the added cost of liquidity can calculate the pricing that I talked about. Here is sort of an example of the simulation, kind of showing just one price, how it looks. And here is sort of showing the combination of price simulation and liquidity requirements. As you can see, we have a particular price simulation for a contract expiring January 15. Capturing all the volatility around this trajectory, and then the corresponding liquidity requirements that can be projected. So if we have a contract with a particular customer which represents portfolio of such monthly contracts, we can calculate the aggregate price and to plan, you know, understand the additional liquidity burden that this contract can pose to the company. Let me move further down. So as I mentioned already, the daily price forecasting allows us to calculate daily liquidity requirements, and the reason we do that is that this is how the exchanges calculate their requirements for margin calls. So we basically simulate the real process that the exchanges go to calculate what a margin calls would be required, and then calculating those margin calls, then we have to come with something that is you know, the price of liquidity. So if we have to post, let's say, additional $50,000, what is the, we can think of this as interest, what is the, how we translate this margin as a cash flow. And then we basically have to calculate a present value. So we have a different parameter, which is our cost of capital, which calculates our profitability and what is the present value of this cost today. And then the final exercise here is because the customer actually is going to pay for this liquidity service at the time of the invoice due date. So we have to then calculate the future value of this contract. And this is what we'll incorporate in the final initial contract with the customer. And some companies call this adder. So from individual contract, then we can move then to the aggregate liquidity requirements. So we're moving now from the commercial to the treasury function and to the financial function. So by putting aggregating all the liquidity requirements, a company can really see what those liquidity requirements are likely to be literally on a daily basis for a planning period. As I probably missed to explain, is that we're using the forecasting model both on an individual contract level and an aggregated portfolio level to assess different liquidity requirements based on the confidence level that the user sets in the model. So this is, in a way, explicit way to incorporate the risk appetite into the analysis. And here we're showing kind of illustratively that depending on the confidence level, one can plan for different amounts of liquidity, 90%, 95%, 98%, and that's kind of it's interesting analytical exercise on its own, so that people actually get a better understanding of the implications of their so-called risk appetite. And then, in addition to analyzing the liquidity requirements of our existing portfolio, we basically can incorporate into the model our forecast for how our portfolio will evolve in the future. So basically adding this future portfolio, we now can actually do the real liquidity planning exercise and really make sure that we secure enough liquidity to meet the needs not only of our current portfolio but also our future planned portfolio. So in addition to the functions that I already explained, some companies, as I mentioned at the beginning of my presentation, for different reasons may decide that they do not want to use futures contracts to hedge 100% of their price exposure. They can decide to take some risk, hedge less than 100% if they have a view on the price. And we all now can look back at the last few years when the gas prices dropped dramatically, and in a sense, if somebody has not been hedged, this would be a bonanza, and for the companies that were hedged, this became a huge liquidity stress because they had to secure cash and liquid assets for huge collaterals. So companies decided, depending on their price view, can look at these different strategies, either using options or just taking some exposure, and analyze both the P&L impact of this strategy and their risk reward profile, and if they fit what are their risk appetite implications. And then the reverse of that, if companies have well-defined risk appetite, if they have something like maximum loss or whatever other parameter, they'll invert the process and basically look what would be a profit maximizing hedging strategy that satisfies this risk profile. And again, working with distributors, this whole thing can be customized. I missed to say here that this is Excel-based with Palisade overlay. So as you all know, this is very flexible and can be customized. So that's basically the essence of my presentation. Here is kind of the simple description of who we are. That was already mentioned in the introduction. And here is my contact information for is somewhat interesting for a follow-up discussion. So that was basically my what I had to present to you, and now I'm open to your questions.
Oh, great. Yeah. Thank you so much, Vlad. Let's wait a few minutes. We had a, let's see. Well, I have a good one to start off with. For those of us who do not work in the field, can you suggest some basic reading?
There's actually tons of specialized literature, and to be honest with you, I actually don't have anything kind of right on my mind right now. But one can do, you know, a Google search, and you know, because the reading here, there's a lot of, one can go in different directions here. One is sort of, you can read about derivatives and analyzing derivatives and all that stuff, and one can read more industry-specific literature. So there's a lot of books, but I don't have anything kind of on the tip of my fingers, as they say.
Ooh, one of our attendees suggested Cox and Rubenstein for Options. It's a good book to start people out with options.
Yes, yes, and there is a very popular book by a guy called Hull, Hull. It comes in two flavors. One is more simple. One is more complex. I'm trying to remember the name now. Options, futures, and other derivatives, or something like that. So people can check this one. It's kind of a very standard text in the field.
Great. Oh, here's another question. Can we quantify risk associated with specific contract in terms of dollars and probability? Can we quantify risk associated with a specific contract in terms of dollars and
that's exactly so again, this application performs two functions. One is commercial and one is treasury. So when again, I'll go through a very simple example just so that everything is well understood. So a customer comes and says, I would like to buy the following volumes of gas from you for November, December, January, February, March 2000 and let's say 15, 16, a year from now. So based on this analysis and on the historical analysis of volatility of prices over this month and the futures curve, this model basically is telling you as a distributor that with 80% confidence interval, the liquidity requirements will look like this, and there's a curve. With 85%, it'll look like that. It's a little more, 90%, 95, 97. So you can see that, and then basically the follow-up, so that's the risk, right? So this is kind of the liquidity risk, assuming again that you as a distributor have hedged all these prices. And then the question then is how you price this risk. Well, you're saying for every dollar that I keep for a month, I demand 1 cent of price, depend on my cost of liquidity. And then obviously, because this is over time, as I explained, you bring this back as a present value for the whole contract. You see what it is, and bring it up as a present value. I don't want to go in financial details, but with the discounting, you incorporate probability. And then you say, but this customer is going to pay to me actually month by month, so you calculate the price, the value of this liquidity price on a month-by-month basis. So that's how you estimate the risk. You incorporate your risk appetite / risk aversion, and you price risk, and you are reimbursed for taking this risk on behalf of the customer.
Excellent. Oh, the title of the John C. Hull book is Options, Futures, and Other Derivatives.
Right.
Yeah.
Exactly.
Good. Hey, thank you. Let's see. Does your model have places to make modifications based on pending Dodd-Frank changes? to margin requirements relating to the OTC versus exchange trading of gas options and futures. I'm not entirely familiar with that, but I wanted to read that out to you.
Well, let's try our Greek. Well, my understanding, again, this is not my narrow field, is that whatever those requirements are, basically we're talking about high level of margin requirements.
Okay. Okay.
So they definitely can be incorporated because, you know, those are just inputs in the model. So that there's no problem to do that. And also my understanding is with mark-to-market requirements, because they're dollar for dollar, in a sense, I don't think that Dodd-Frank will have any impact on those.
Good. Let's see, do we have any more questions? Just wait a minute. As a producer distributor, would you incorporate real options into your model?
Well, sort of, I mean, I've written a book on real options, so it's this question is it's a little broad, sort of what we define as real options. Absolutely, as a producer, basically real options puts financial value on managerial flexibility. So if we require flexibility, or if we provide flexibility to customers, we should use real option methodology to price this flexibility and articulate the value of this flexibility either to the customer or to our own company.
Good. I think we have time for another question. Our folks are saying thank you and great presentation. So let me, we'll take one more question and then we'll. Great feedback, Vlad. We're getting some good feedback, and especially
Thank
for
you so much
yeah.
for that.
Wait another moment. Well, of course, if you have questions and we don't get to them, you can email me and you can email Vlad, and we'll certainly address them. And anyway, Vlad, thank you so much for this presentation.
Thank you, everybody, and appreciate your time again. I know how busy we all are, and I hope that this was useful and productive.
Yes, thank you. Oh, one more question. When is your new book coming out?
Well, you know, it's interesting that after you write a financial book, at one point it dawns on you that you should apply the financial analysis to the craft of book writing itself. And you realize that the net present value is profoundly negative.
Oh, no.
So for now, I'm kind of more interested in writing specific pieces or write specific solutions. I have some ideas, but nothing in the shop for now. So just that's, I guess, is the short answer.
Great. Well, thank you, Vlad, and thank you, everybody.
Thank you. Bye-bye.
Hey, thanks.